Good morning, everybody. Welcome to the Flow Show. Another busy day to get stuck into. Lots for us to talk about as usual. Morning, K-Man. How you doing?
Hey, morning, mate. Welcome back. Morning, everybody.
Thank you very much. Thank you very much. As I come back, it's like a revolving door in this place. As I come back, still clears off. There's a bank holiday over in Greece, so he's surprisingly on the beach for a change.
Those Greek surfers, you know, they you can't hold them inside.
Exactly, like caged beasts if you keep them inside. Right, well, let's get straight into it because there's lots going on, and we'll kick off in China. We had another flood of data coming out overnight. Industrial production coming in on pretty much close to the money, let's put it that way. Positive numbers, year on year 3.7% versus 4.3 expected. So miss on expectations, a bit lower than last month, but still a positive number there. Year to date number was 3.8%, matching expectations and the previous number. Retail sales as well out, softer than expected again, but still a positive number. Again, the year to date numbers were a little negative in terms of matching expectations. They came in at 7.3% versus 7.6% previously, and 7.6% expected, and a prior 8.2%. So that's pretty much that number in there. Unemployment as well ticked up a pip as expected to 5.3%. As you can see there was a National Bureau of Statistics press conference after. The key line from that was pushing the point that there is no deflation in China and there will be no deflation in the future. That tells you everything that they are mainly concentrating on there. One of the big things is not to allow deflation to get entrenched in any way, shape or form in China. There's been some more financing issues, let's call them that, and China has set up a task force after one of its top wealth management firms missed payments. If I get this pronounced right, Zhongji failed to make payments according to multiple investors. They have investments totaling around $140 billion, and they failed to make payments on that. Those payments were to the KBC Corporation, which is in the semiconductor sector, and also a property services firm called Nay City Property Service Group. Neither had received 60 mil and 30 mil yuan payments. Small payments in the grand scheme of things, but that could raise bigger issues in the fact if they can't make small payments, they're going to make big payments. So it's further problems, as I say, in the financing side of things in China. They set the midpoint at 7.1768 versus 7.2648 expected. But they're still trying to keep the brakes on it in terms of the fixings, but that's not stopping what's happening to the yuan in general, and we're knocking up into the 730s now. So the brakes have been applied, but they're not slowing the roll down the hill. As such, Chinese state banks were seen selling dollars again versus the yuan around the 728 area, or when it got to 728. As you can see, we're through there. The bigger news from China is they've started cutting rates again. The 1 year MLF was expected to remain unchanged at 2.65%, but they cut 15 pips off of that. They also cut the 7-day reverse repo rate to 1.8% from 1.9%, so 10 pips off that. Then this morning they cut the SLF, standing lending facility rates, for 7-day and 1 month by 10 pips each. So further cuts coming from the different smaller, let's call them smaller rate things they've got over there. I'm wondering if this is going to be setting up for a big RRR cut down the line, which was touted maybe for the end of Q2, possibly into Q3. So I think given the data, given those inflation numbers, we could be heading that way for some proper cutting of rates over there. What are you making of all that, Kay? Bit of a rabbit out the hat, cutting the rate when expected to keep it unchanged, but they couldn't really hold off, could they?
Misery, mate, misery. It's not going the right way over there. Locally, it's not going well. The country garden is not doing well. Zhongxi is not doing well. We spoke about it already yesterday as well, and on the flow show here. And and then what I was chatting about in the chat room yesterday afternoon is exactly what happened. They keep those fixings ridiculously low, trying, because they have this buffer, right, that they can use. But now they are like more than 900 points below the where the model is, which is, I don't think I've ever seen that. The dollar CNY was also trading around 727, 728. So the local one, the onshore one. And now they are starting to cut rates. The next one on the list, they're talking about RRR, but the loan prime rate, the LPR, and I think that's expected in the upcoming days as well, or is it early next week? That would be a pretty big one to cut if they would do, and especially the 5-year one. I think it might be next week. I'm running through the calendar of this week. No, it's I think it's early next week. But yeah, what we were already saying a while ago, if the domestic market doesn't work, they will have to do something. So we saw this thing about PBOCs constantly injecting liquidity. They are cutting rates, and then at the same time they are to confuse the market. They are fixing the CNY ultra strong, and sometimes sending their submarines out, but that doesn't tell investors that things are going the right way. We were talking briefly on the flow show. I think whether it be on I don't recall whether it's Friday or yesterday, saying that the finality of things is not looking good until they're really going to cut very, very strongly in everything, either going in the market with real haircuts on payments, and taking over the whole shit and start all over again, clean the whole tables. For now, it does look like what they are doing is not telling investors to reinvest in China. Yesterday they were trying as well to come up with a curve on direct investment restrictions into Chinese firms, but that only helped like for 15 minutes or so, putting dollar yuan down from 729 to 727s, and that was really it. No, it's not a good picture right now in China. That's definitely the case, right?
Yeah, and I did the trade-off yesterday and talking to Michael about dollar yuan, one of my subjects. When we were running up in this leg here, I was saying we were going to get stronger intervention when we got into the 720s, particularly towards those highs, which we did do, which got us the little sell-off for a month. But I thought perhaps they would allow it a bit more to flow or to weaken a bit more this time around, rather than when they started to put the brakes on the first run to 728s. Because a weaker currency would help their exports in one sense, and maybe encourage inflows into China. Do you think that might be a case that they're going to be happier? They're not going to let it obviously take their foot off the brake pedal, but would they be happier to let it weaken? And could we see it significantly weaken or get more weaker from here? Maybe up through that 736 highs, maybe even to the 740s. Do you reckon, Kay?
Yeah, well, that's paradoxically what they may be looking at today, but they really want to confuse the market, as I said, by fixing the yuan stronger and sending their submarines out. They just don't want it to go too fast. It's a fair point that they want to weaken the yuan to beef up the exports, but it's not as simple as that. I think they have a real issue locally. their local economy is, and don't forget, there's also those floodings and stuff like that. Their local economy is right now on its knees. I'm not saying it's completely flat, whatever, and nothing's working there anymore. But Europe doesn't want to decouple from China, and actually we have seen import data from China into Europe, and they are not looking that bad. But it's the Chinese local economy that they have to beef up first before you start to attract foreigners to invest in your country. So there's still an issue, some issues with supplies, although they are getting a lot from here and there in Asia or in Russia. But I think what's going to turn around the Chinese yuan more than exports right now is that if they get their local economy back onto their feet, that's going to turn it around. In the meantime, I think this is a confidence crisis, and whether it's weaker for exports, that would have been the case. I would have bought that story if their local economy wasn't that bad, and if their developers are going down one after the other. And now investors like the Zhongxi, the wealth managers are starting to miss payments. That is not a good sign. So I think the exports is perhaps a worry for later. It may help this move, but I don't think it's the main mover of this move.
Yeah, and unless there's been news out already that I missed while I was away, I think we're probably going to have to watch out for any comments on outflows, because even foreign investors won't be liking what's going on in China. There's already been a big drive to get money out, so we may be seeing that pick up as well, and that might be something that the officials talk about, outflows from China, because they'll want to put the brakes on that, particularly if it's from Chinese investors and citizens taking their money out of the country. That's something they'll fight against tooth and nail. But it may be part of the reason, several reasons why we're seeing pairs like $1 strengthening or going up. Anyway, that's we can monitor that if it happens. Right, coming over to Japan and looking at some of the data there. GDP data looking very rosy over there. Quarter on quarter, GDP coming in at 1.5%, beating expectations, nearly double expectations. The same for the year-on-year number, or year-on-year annualized number, coming in at 6% versus 3.1 expected. The year-on-year number also beating 3.4% versus 2% expected. So you can see there pretty positive data, although there is some little minor worries. Business investment or business spending was flat. You'd like to see that a nice positive to add to the picture there, make it sort of full house. And private consumption as well, down 0.5%. Again, you'd want to see a nice positive number there just to round it all off. So good numbers overall. We know that the economy has been plodding along, doing well, as the economy minister says, that the moderate economic recovery is likely to continue. Now, also within that data, there was the net export contribution to GDP, and that was 1.8% versus 0.9% expected. That's that number there, external demand. So good pick up in exports there, again, double what was expected. So positive numbers. Not that you'd see these positive numbers reflected in stronger yen today, mate, but still it's going the right way, isn't it?
No, yeah, that's it. So the main contributor are those exports, but I think that's what I said yesterday as well. We've got those Japanese data out, but the last time that Japanese data have really moved the yen is a while ago. Although we can't ignore them, right? But then you have your half reaction again, where you go like, yes, the exports are up, and perhaps it's like nominals, which with a weaker yen makes sense as well, that the nominal exports are higher. But then what's really bothering in those numbers is this lack of consumption and lack of the capital expenditure, and those things normally are we need those to be positive to be long-lasting drivers for this GDP, right? And that is where still it's a bit of an issue. And the private consumption is as well, right? If we've seen that I read a couple of articles saying that the consumer is already scared that interest rates will go up, so they're already upping their savings again. So yeah, it's a difficult one in Japan, really, to read into data like we would read in another part of the world, like for instance the UK or the EU or the US. It's a bit of a more complex read in Japan.
Yeah, exactly. And Ali's got a point here. Sky is the limit for the dollar is not justified. I think only a little spark in weakness in US data will spark a great sell-off in the dollar. I don't think so, because as you've said further in that comment, you know, it's every economy will get hurt in this, and we're still playing who's gonna not collapse the worst. And everyone's looking at various soft landings. You know, except for countries like Germany, some of the others, Spain, Italy, are not looking too bad. The UK is looking better than expected. The US is still doing better than expected. But it depends what dollar you're looking at. If you're looking at dollar yen, there's clear reasons why that's ramping higher. If you look at others, cable, euro dollar, dollar CAD, they're not doing an awful lot. Aussie dollar's looking a bit weaker. But in terms of, you know, we're not talking hundreds of pips moves here. We're talking very small stuff. So these moves are selective. You know, dollar China is selective, dollar yen is selective. But if you look at the whole dollar space itself, it's not, I wouldn't say it's all rocketing higher. So I don't think that the sky the limit is really the right reason or the right description for it. It's all, as I say, depending on what dollar you're looking at. But we'll look at the prices in a bit in more detail. Still in Japan, Suzuki and Kanda, the finance minister and the FX diplomat, as he's called, have both been out jawboning about the moves in yen, ready to do what's appropriate if needed, watching FX moves, sense of urgency, blah, 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 the usual stuff. Again, I don't know if I've missed anything, Kay, but are we still on low DEFCON levels for this in the jawboning stakes?
Yeah, yesterday I was saying I was a bit surprised with the move above 145. I'm not, well, I think the market was a little surprised with the move above 145 that we didn't hear from them yesterday, but then we heard from them overnight. Yeah, we were looking at those moves since the Bank of Japan. It's pretty solid moves. It's more than 7 big figures. Yeah, so we may expect them. But then, if you look at the rest of the dollar moves, the dollar has moved a bit higher versus some currencies, more stable versus others. There's little they can do right now because the yields are moving higher elsewhere, and their own yields are not really rocketing. Because if you look at it, for instance, on the Japanese JGB yield, they're at 0.63%. Yes, we were back below 0.60, but with such GDP numbers, we may have expected them trying to push higher, but still not convincing. So yeah, the yen is still suffering, probably a little bit in sympathy with his far away cousin China also, but yeah, for the time being, I don't know what stage they really are at, but we haven't heard the speculation word, right? So let's see if we are going to get that before any possible thoughts of interventions. I do think, though, that if you look at the yen crosses, they may be a little bit worried about those because they are going higher, despite the rest of the dollars being like going up slowly, but the dollar yen is pushing higher. We are in some of those pairs, we are higher than where we were on the intervention in November. So I don't know. We always have to be a little careful. I think there's a big zone coming up in dollar yen in the 146, as I'll show that.
Yeah, no worries. How are we in the basket terms compared to where they intervened last time? I know one of our roomies, DKT.
We're still a little away, which is a bit strange. But I reckon those moves, the last couple of days' moves, must have brought us a lot closer to those levels again on the basket. So yeah, it's an interesting one. We should have. We'll ask our mate in the room to have a look at it.
Yeah, definitely. Right, well, moving on, because still plenty to talk about. The RBA had their minutes out, and it feels like deja vu to the last meeting, where the board considered hiking 25 pips or holding. And they agreed the case for holding steady was the stronger one. They saw a credible path back to the inflation target with rates at their current level, but agreed it was possible some further tightening might be needed. So no real change in mood from them via the minutes. We've heard most of that from the announcement anyway. Over to the UK and data out of their jobs data, which is part one of some big data this week for the UK. Is going to be very influential for the Bank of England. On the whole, there was some good, there was some bad. The claimant count was up for 29,000 versus minus 7.3 expected. The unemployment rate rose to 4.2% from 4%. But the wages is where all the real news is, and there were some strong numbers there. Average earnings, including bonus, jumping to 8.2%. Strip out bonuses, that also jumped as well, up to 7.4%. Now, there were some skews in there as well. We had this public sector NHS pay deal that went through, and bonuses being paid in arrears and that sort of thing. So that has been a bit of a tailwind for these wage numbers, but I expect those are probably going to start washing out from next month. It doesn't mean we're going to see lower wages or negative wage numbers, but the influence from that should start washing out. They look at, as you can see, they look at these wage numbers as much as annually. They look at them on a 3-month basis, so it includes 3 months, like a 3-month average. So these were, I believe, April, May, and June, 3 months. So then next month is obviously going to be May, June, July. So we should start seeing that washing out. But anyway, the public sector has been a big driver on the wages, and that may start to ease a bit as well. Annual pay has turned positive based on the annual wage numbers. Obviously, with inflation coming down, it's turned pay positive in a lot of the metrics there. Now, most of the pay rises were driven for the private sector, driven in financials and manufacturing, which saw the biggest pay increases since the data began. So still strong numbers coming through on the private sector. That's the most important for the Bank of England. Public sector wages don't go on forever. They're not a rolling thing. The government is very reluctant to give pay rises to the public sector anytime. But the private sector is a different kettle of fish because they're free to set wages as they want. So we know there's been strikes, there's still strikes going on, teachers, train drivers, that sort of thing, although the teachers have been resolved in the main. So it's the private sector wages going higher that is going to be forefront of the Bank of England's mind. And I think these numbers keep them on the hawkish side. As far as the market is concerned, they saw this data and the pay data, and now we're back to pricing peak rate at 6%. After this data, it was down to sort of 5.75%. Money markets now see, or they're fully pricing a 25 pip hike in September and see a 20% chance of a 50 pip hike coming in. On the probabilities, we were pricing an 88% chance of a 25 and a 12% chance of a 50 at the next meeting, which is in September. And I think that's probably about right on this data. Now, we have got CPI coming up as well. Again, that could completely flip things around to what we're seeing today if we get some big soft numbers. The numbers are expected to come off quite significantly, 1.1 percentage points on headline inflation, but only 0.1 on the core. That's coming on Thursday. Is it Thursday? What are we today? No, that's coming tomorrow. So tomorrow morning we get the CPI data from the UK. As I say, that one could completely flip around these expectations if it's much softer than expected. Though what I would say is, with inflation expected to drop to 6.8% from 7.9%. So say big lump, that is 1.1 basis points. I think that leaves a little bit of room for an upside surprise. It's a pretty big gap to see inflation coming in hotter than that. So I wouldn't be surprised if that happens. If it does, we're going to see those expectations for September ramping up a bit stronger. Not that it might mean anything for the quid, which is still pretty much traveling around recent ranges, but we'll see what those expectation brings. Over in Germany, the zoo was out, and we were a little bit less crappier on one. As you can see, that economic sentiment coming in better than expected, but still a negative number, and current conditions going further into the negative. So we're not talking about improvements here. We're talking about things being less crap than they were before. That's all I've got on the headline front and data. Unless, Kay, you've got anything else that you want to
add? The only thing that really caught my eye from yesterday as well is that drought everywhere is starting to have an impact, and specifically for the Panama Canal, where the severe drought over there could be hitting the global shipping industry. So that is something that we should keep an eye on, in my opinion. We know that it has been, we've been talking about it previously, and it has been an issue in Germany, for instance, when the rivers dry up. But if stuff like the Panama Canal, starts to run dry, then it will have potentially a much bigger impact. So that is something that we need to keep an eye on, because I'm just reading the article through, is that up to 30% of container trading crossing the Pacific travels to the canal. So that's one big percentage, okay? So I think that is one. Perhaps not today, perhaps it's going to resolve itself, but we should, I reckon, keep an eye on that, because that could have an impact on prices for commodities, for instance. That could have an impact on shipping rates and on a lot of stuff. So I think it's a bit of a risk factor there. There we have to keep an eye on that one, at least, because it could all of a sudden impact some markets.
Yeah, it's a bit of a strange one, that one, because it's a controlled waterway, so it has locks in it. So I don't know how they can't keep it full of water. I don't know how much gets siphoned off, obviously to local areas. But it's a bit of a weird one that they can basically let the water in from both sides and keep the levels up. But the point you make, again, something I made talking to Michael on the trade-off. I'm beginning to think that we need to keep a closer eye on commodities anyway. The reason being is, we had this stuff with nat gas the other day. We've had the Russian grain deal business going on. That's impacted wheat prices. We've had India putting export bans on rice, another commodity, particularly food commodities, come into the fore as well. And I'm just thinking we may need to keep a closer eye on what's going on in the commodity space, because that's going to impact growth, that's going to impact activity, but also it's going to impact inflation. If we start seeing food inflation rising once again, that's going to be another input into every country's inflation picture, but one that they can't really do anything about with rates. And that's going to be a sticky situation for central banks, because you can't, if you're a big importer, particularly of food, and you're paying higher prices, you can't really do anything with rate cuts on that. Is that something that could bring us a second round of inflation, uncontrolled?
I think that the bigger word there is just we need to start paying close attention to climate change and what the impact may be of it. And I'm less worried about inflation really than what it does to growth globally, and that may be one factor where we are going to have to pay closer attention to. We as traders have been able to shrug it off for a good while now, but perhaps it's time to start really monitoring for longer term pictures about what's happening and what the impacts are of climate change. That's not a daily change. That's something that is going to happen over the course of the years. But then we are seeing those things popping up left, right, and center now. Germany, Panama, whatever you name it. And there's geopolitics in the mix. It's perhaps a good time, or perhaps a good time to start worrying about what the impacts are of climate change.
Yeah, well, I'm not gonna get in a climate change conversation with you on this one. I've different views of what climate change is and means, but yeah, the effects are there.
No, but I mean,
so mate,
what it does and means is a different, somewhere a different discussion. What the impacts are is the discussion that can drive markets.
Oh no, absolutely,
drive them very, very, very hard. Very hard.
Yeah. Yeah, no, I agree with that 100%. It is, and as I say, it's something that it's one of those things where you hear stories, and you hear one story, then you hear another story, and you hear another story, and it just all stacks up in my mind anyway, as a trader, that a particular sector or asset class is finding some problems, and the commodities is a sector that's going to happen. We still got the Ukraine war going on. We need to watch what's going to happen to gas prices later on in the year. Everyone forgets about it now when they're in the middle of a heat wave, but that's going to have an impact later in the year if stocks haven't been filled up, or if Russia decides to mess around in the winter again. It's all going to impact markets, so you have to try and keep ahead of everything as much as you can to see what's coming further down the line. Right, Kate, I'm going to hand the baton over to you for the prices, because I'm doing a little bit of catch up in terms of what's going on. So I'm going to let you go over a couple of pairs and assets if you want.
Yeah, sure.
I come back in. Let's in that. There you go.
Okay, so first of all, we have to look at what's happening in yields, right? This is going higher, and even though there are no this is going higher. I'm not talking about the future. It is going higher right now. They are going higher right now, the yields. And even though we don't have like big treasury issuances this week, we know that this quarter there's going to be more. We are very close to the all-time, or not all-time, latest 50 years highs around this 424, 423. The tens, I think we're in for a retest of that 433 here. Doesn't look like the markets have enough of it right now, and there's some of those bonds, and people are talking about TLT. I'm not really a close watcher of it, but we have really this thing is really breaking down. Yeah, you see my chart is not good enough to look at, but anyway, the yields are pushing higher. They are everywhere, but so the European yields are catching up a little bit as well today. But we've seen this this drop that we had, which explains the drop that we saw yesterday. In fact, right, the drop that we saw yesterday to the lows of the latest ranges in the euro dollar as well, dragging everything, all those dollars lower. Now the euro dollar went to tag the 61.8 of the run up from the 106s. That's your level to watch. If you look at the euro dollar, and especially what it's doing now, I've been saying it for a number of days. I think the euro dollar is rather in a range. Euro and the dollar are roughly walking together versus many currencies. So it's not surprising for me that we rejected this and that we're still struggling in this range. I don't see too much reason to buy euros right now because we see the data in the European Union also being quite average. And we see the US yields going up, so that's keeping the rest of the dollars higher. But this is really telling me as well that the European crosses are supported, which is what we see as well. We see the euro yen back above 159, for instance, and we're seeing those euro versus the antipodians and the rest pushing higher. So this is keeping the euro dollar in a range. I'm not really in a hurry to trade anything. If you would trade anything, I'd say ranges are still your best bet. If it starts to go back above 109.70, I reckon we are going to have a look at the 110s again. But I don't see it run too much higher either right now. There's also decent expiry still in the zone this week on the option front. So they could be pushing and pulling a little bit, but right now, unless we start to see a change in the US data, which may be this afternoon already on the retail sales, but we'll have to have a look at that then. I see it in a range. And I've got the same impression on the cable. Yes, we have seen this run into the dollar with those higher yields. And then we did exactly the same as on the euro, right? We put this this low in back to the prior lows, 126.20. I highlighted that, and we bounced off it again. Then we had this, I still call it a half report on the UK jobs report. Yes, inflation. Yes, we are expecting the Bank of England to have to react of it. At least the market does. But then when you look at the bit of job destruction and the unemployment rate ticking up, there's not too much reason to get overexcited on the sterling either. I think we're in a range here as well. Call it 50-60 on the top side. We should be watching as a first level, and then it's over to the United States data to tell us whether this is going to go back up into pushing up into the 128s, or we may be in for a bit lower levels. It could be a double bottom, as you say, Bran. It has the looks of it, and it could if we start to push above, what is it, 128, 128.15, then you are going to confirm it, and then we're going to move higher. Does it have the strength to do it? I don't know right now, is my answer. One word of mention is that there's decent expiries today around 86, the figure in the euro sterling, and it does look like magneting a little bit. So keep an eye on what's going to happen there around 3 p.m. or 3 p.m. London time, 10 a.m. New York. On the daily expiries, there is some activity on the euro sterling right around here. It looks like a bit of a broken trend line, but I will say that in line with what we're seeing in cable, euro, dollar, and what the developments are lately in sterling and euro on each side, that we are still inside ranges, right? Until it doesn't break 85 or 87, this is a range, and the ranges are getting a bit tighter. So I'm not going to look for too much in here. Dollar yen is pushing through. Dollar yen is pushing through, but We just checked, and thanks FT in our chat room, very helpful, to the trade weighted index on the yen, and we are back to October-November levels. So we need to pay a little bit of attention to what's going to happen in the yen over the next coming days. There is this this channel, this trend line that comes in around 146.40.50 today, and you have the 78.6 of the 152, 127 decline, and we have seen those levels pop up in the past because there was the combination of interventions, but there was also, remember, when the US inflation data were starting to come off, which ultimately really created this move, and because of the sharp move lower in dollar interest rates. So I'd argue mid 146s is an important enough level for the dollar yen. Okay, still carrying some of my option, but if it gets up there, whether it goes higher or not, I don't care. But for a temporary reason, at least, I'm going to take the rest off or completely hedge my option there. That for the dollar yen, we're seeing those, as I said, we're seeing the euro yen push through. This could take us into well, easily now into the 160 zone. Got something in the high 160, but if we have to go back to the weekly to see where the real resistance lies, and that would come in if you look at the really historic levels, 164. Watch out if ever this reaches 164. Okay, I know we've been higher than that ahead of the global financial crisis, but 164 will already be good enough in my opinion. Yeah, sterling yen, same thing. I mean, all those yen crosses are really going higher. One of interest here is the Aussie yen, because both currencies are a bit weak, yet we had this little push up in the Aussie yen, if you look at it, early in the morning, and we've rejected it. Okay, close to 95. Keep an eye on what's happening at 95 in the Aussie yen. And then, of course, one we need to mention, yeah, is the dollar China. We've broken, okay? I mean, I was talking about this 727, then the prior high. It's breaking, okay? It's with everything that goes on in China, I think now it's breaking. I think that the new levels of no return have moved up from 710 to 720. We are seeing that the PBOC is keeping the fixings stubbornly low. They have this I don't recall the terminology, but it's like a kind of buffer liquidity or something buffer that they can use to fix it artificially low. But they at the same time they're cutting interest rates. So I think your new level of no return now is going to be 720. In the meantime, keep an eye on what's happening between 727, 728 if it would come down. But I think we are going back to these levels, bit of an intermediate station around 733. And if you look at it on the weekly in this dollar China, why did that? Oh, yeah, no, I need to redesign that. I need to redesign it. Yeah, this is one that we spoke about, a bit of a 61.8 of historical levels, around 741, 742. And I recall having spoke about that level when we were up in the 730. So perhaps if we get an overshoot, be careful what's going to happen there. It could get up to 750 if you look at this, but then perhaps something already going on in the 740s. But for the time being, don't change. No change of view needed. This is pushing higher. And with that, Ryan, for today, I give it back to you.
Thank you very much, mate.
I'd say keep an eye on the dollar and the Canadian. Oh yeah, the Canadian dollar perhaps quickly, because we have the CPI out today, right?
Yeah, I can have a quick look at that. Hopefully my screen.
I was just going to get onto it. You take it, or?
Yeah, I'll grab it quickly. Give me something to talk about.
Go for it, mate.
As long as my screen shares, can you see my screen okay?
Yep, go for it.
Cool. Firstly, just back to Ali's question, what if the UK economy has similarity with the US economy? And the higher the BOE go, will we think the UK will be in recession? I'm fairly neutral on the pound in general. But if you're looking at cable, I don't really have a bias. The only slight bias I've got is that obviously whatever happens in the US is going to overshadow purely by size what happens in the UK. So if the US economy is good and the UK economy is good, the market will side more with the US dollar in terms of where it wants to park its money. So that's my only sort of negative bias for cable, at least. Technically, it speaks for itself. You know, we've hit the fibs here. You know, it's both a bit of confluence around this area, around the, you know, the 126, low 126s. We've had a couple of goes down there. We've held. So technically, that's what you want to do. If the fundamentals give me no clear insight in terms of bias or direction, then I go purely to the techs, and the techs tell me how to trade it. I am short the pound via euro sterling, but that's more of a technical trade off the 85 level that I was banging on about for ages while we were all the way up here. So I am short the quid, but fundamentally it's not something that's playing into my considerations at the moment. Either we're going to break up through 87 or we're going to break down through 85, and I'll trade it as such. So that's my thoughts on the pound. If you're going to look at the fundamentals and match the US against the UK, the US will win out if things are sort of level pegging, if you get my drift. Right, dollar CAD. And as Kay was saying, yeah, we've got the CPI coming up. Let's get rid of some of this stuff here quickly, because I've got loads of lines in here. For me, it's all about 134, 135. Pretty similar to what happened when we were 133, 134. And I'm looking at similar situation for that. We're in my zone at the moment, a bit of a traffic zone. So we're tuned through that. We did have this move under 134 last week. I had a break trade on this move here, which got the trailer got knocked out on that one down at 133.80. I'm looking to get back in potentially 134, or else look for a 135 break. So playing it similarly to head down here. Now the CPI we've got coming out, and we'll just take a quick look at what's expected. So CPI is expected to jump in Canada as well, up 2 pips to 3%. For the core number, we're looking for a move lower to 2.8%. Now they do have several goes at trying to guess the core number. All these ones: core common, core medium, trimmed, BOC core, etc., etc. So all those core measures are expected to come lower. If headline CPI goes up, but the core is confirmed down, that wouldn't be a hawkish set of numbers for the BOC. If we see a jump in CPI, but the core numbers come in above expectations, that might put a bit of a slant to the hawkish side for the BOC. But as you can see, the market, I don't know, the market doesn't seem to be trading a lot of BOC at the moment. It's everything else that's going on in the dollar, going on in oil, or not going on in oil, as it likes to jump on and off the bus as it requires. So for me, I don't know. I wouldn't trade a break on 135 unless the data is really soft, and I'll be worried that it would just be a data move. So if we do get a break of 135, I'll be looking for confirmation that that break has held, rather than going for it. But afterwards, after the data and things settle down, I might look at potential break trade here. I'm still long down from the 131s, so I've got lots of margin in this trade. And conversely, I'll be looking potentially for a buy down into the 134 area, should we see one. What are your thoughts for this one and regarding what's going on, the BOC and inflation and oil and everything else, Kay?
Looking at how the market trades, I have the impression that the market may use any uptick in the CAD that is a bit lower to the CAD as an excuse to buy the dip again. It looks fragile, and you look at it across the board. It's like it looks as if we are in a dollar, euro, and sterling versus the rest of the world, and then with China on the other side of the spectrum, and everything else in between, which is it gives me the feeling where it's not great for risk right now, despite the equity markets are being in ranges. But we have seen is the US equity markets are in ranges. The rest are looking a bit fragile, right? So yeah, I'd say we are rather to see buyers on dips than sellers on rallies in the dollar CAD. If the CPI would either be a tick or so stronger or a couple of ticks weaker, I think that would have the bigger impact.
Yeah, and I mean, it looks very similar price action that we saw here when we were testing 134 as we're seeing here. So you can see you just got a general gradual climb back up, and then we get a break of the level. And this is looking in part a bit like that as well. You know, we're just trending a bit higher. We're, you know, making those higher highs and making those higher lows and just keeping the move going. We've already had one test, you know, last week at 135, and this big move, strong move here, which proved enough. This looks to be a bit more like it's building for something, but a level's a level until it's not. So the 135 is the consideration here, but I'll see how it reacts after the data. If we break, have we held?
Yeah, if you zoom out a bit, though, you can see there's a bit of a traffic zone once we are back above 135. There's quite a bit going on there. Look left. There's quite a bit going on there. Yeah, no, right around there where you were is fine enough. Yeah. You see this 1, 2 before we have the biggest spike in between. You see these 1, 2, 3 zones, and there's a bit of traffic up above 135.
Yeah, and the big number is for me is going to be up here 136.5. Call it that, but yeah, there's plenty of levels in between 135.5. Obviously, the big figures in play, and I'm going to have to do some redrawing, I think. But yeah, some solid numbers above. But as I say, if we do get a break of 135 and it comes over the data, you want to see the reaction, you know, 10, 20 minutes after. Have we held it, or are we back below? That'll give you tell you what that data means. Anyway, that's it for today. Thank you very much for coming to the Flow Show, and thank you to Kay and Stel for holding the fort while I was away. I'm sure they kept you well up to speed on what was going on. So have a great day, everyone. Watch out for the data later on. We've also got New York Fed, Empire State Manufacturing, the first numbers for manufacturing for the new month, and obviously retail sales coming all on top of that Canadian CPI. So double bubble for the loonie there as well. Have a great day, everyone. We'll see you bright and breezy tomorrow.
Have a good day.